Welcome to the video on solutions to be considered for managing AI risks in banking, specifically addressing concerns beyond simple DPDP compliance, based on the insights from RBI Governor Sanjay Malhotra's address at FIBAC 2026. This video is built around RBI Governor Sanjay Malhotra's remarks at FIBAC 2026 in Mumbai and related RBI guidance on AI in banking. The core message is simple but powerful. DPDP Act compliance is necessary but not sufficient for AI in banking. We will walk through the 6 AI risks Governor Malhotra highlighted, and then link them to concrete solutions and RBI's evolving AI governance framework. The RBI is emphasizing these risks now because AI's rapid integration into banking requires more than just standard privacy measures. A proactive, risk-first mindset is essential for the future of the sector. At FIBAC 2026, the theme was Winning in the AI Era, the new playbook for Indian banks. In his keynote, Governor Malhotra clearly stated that banks cannot treat the DPDP Act as the only lens for AI risk. They must do much more than mere compliance. He then framed 6 distinct AI risks that all banks need to recognize and manage: explainability, bias and exclusion, concentration and herding, third-party/vendor dependence, data privacy and DPDP compliance, and cyber and adversarial vulnerabilities. AI acts as an intelligence multiplier for banking, offering benefits like improved fraud detection and personalized service, but it also carries risks that could potentially worsen social or financial exclusion. The governor described AI as doing for intelligence what past technologies did for muscle, energy, and connectivity. It multiplies human decision-making capability. For banks, AI is already influencing credit assessment, fraud detection, collections, customer engagement, and internal risk management. Deployed well, AI can improve financial inclusion, for example, using cash flow or GST data to responsibly extend credit to thin-file customers. Deployed poorly, it can cement new forms of exclusion and amplify instability. It is important to understand that DPDP compliance represents only a baseline. True AI risk management covers systemic, cyber, and model-specific threats, requiring a go-beyond-the-checklist approach. The DPDP Act focuses on digital personal data, consent, purpose limitation, data minimization, rights, and safeguards. AI systems add layers of risk that DPDP alone does not cover: model risk, explainability, systemic herding, third-party dependencies, and adversarial attacks. Governor Malhotra's message is that banks must not be satisfied with ticking the DPDP box. AI requires a broader governance and risk management architecture. The RBI has identified 6 primary risk categories, ranging from black box explainability and bias to third-party dependence, data privacy limits, and cyber vulnerabilities that banks must navigate. These are the 6 risks Governor Malhotra explicitly highlighted in his article and speech. We will unpack each one: what it means in banking, what could go wrong, and what RBI expects in terms of governance and controls. Keep in mind, many of these risks interact. For example, vendor concentration and explainability can combine to create systemic and accountability gaps. The first risk the governor mentioned is the black box or explainability problem, when even the bank cannot properly explain why an AI model made a given decision. In Indian banking, regulators and customers have a right to clear reasons for outcomes, especially in credit, pricing, and fraud decisions. This is reinforced by RBI's fair practices and digital lending expectations. The governor has emphasized meaningful human oversight, the ability to explain, to intervene, and where necessary, to override, must remain a design principle, not an afterthought. Technical methods like LIME, SHAP, and counterfactual explanations can help give post hoc explanations for complex models. RBI's draft model risk guidance expects model documentation, inventories, performance metrics, limitations, and clear ownership. This is the governance counterpart to XAI. For material decisions, i.e. loan rejection, fraud blocking, banks should have human review, override capabilities, and stress testing similar to other material risk models. The second risk is biased or exclusionary outcomes. AI models trained on historical data may internalize geographic, occupational, or socioeconomic biases. Even if explicit variables like caste or religion are omitted, proxies such as PIN code, type of employment, or language can indirectly reintroduce sensitive correlations. The governor has warned that careless AI could create new forms of exclusion and financial instability faster than regulators can respond, especially if thin-file or underserved groups are systematically disadvantaged. Mitigating these biases requires a fairness-by-design approach, ensuring representative data for all demographic groups and conducting ongoing bias audits and red teaming exercises. Start with fairness by design. Define fairness metrics, protected groups, and acceptable trade-offs at the design stage, not after deployment. Training data must include adequate representation of women, rural customers, informal sector workers, and vernacular language users to avoid urban English bias. RBI's free AI report and broader commentary call for regular bias monitoring, red team exercises, and stress tests to identify harmful patterns before they manifest at scale. The third risk arises when a small number of tech vendors or models become dominant across many institutions. If everyone uses the same external credit or trading model, a defect or bias in that model can cause correlated mispricing, lending, or de-risking across the system. This leads to herding, synchronized actions that amplify pro-cyclicality, volatility, and contagion in the financial system. RBI's free AI work encourages sector-specific indigenous AI to reduce overdependence on global, generic models and to better reflect Indian data and languages. Banks should avoid one-size-fits-all vendor models by insisting on customization and aligning models with their own risk appetite and customer base. At the regulatory level, model-driven scenarios and stress tests can help assess what happens when many banks react similarly to AI signals, or when widely used models behave unexpectedly. Risk 4 highlights third-party dependence. Many banks, particularly mid-sized and smaller ones, will rely on third-party AI vendors, cloud platforms, or fintech partners for models and infrastructure. RBI and multiple commentaries stress that outsourcing does not outsource responsibility. The bank remains accountable for outcomes, compliance, and customer harm. Risks include weak vendor controls, chain outsourcing, non-compliance with Indian regulations, and difficulty exiting or switching providers. RBI's model risk expectations require independent validation of models, regardless of whether they are developed in-house or provided by vendors. Contracts should address data protection, performance SLAs, regulatory compliance, audit rights, subcontractor oversight, and clear exit/transition strategies. From a governance view, every third-party tool that makes or influences decisions must appear in the bank's model inventory, with owners, validators, and risk tiering. The fifth risk is that AI use may remain technically DPDP compliant, yet still be privacy invasive, especially through deep profiling, cross-use of datasets, and opaque inferences. DPDP obligations clearly apply to AI activities, training on personal data, using models for decisions, and storing outputs that relate to identifiable individuals. Banks must therefore apply privacy by design across the AI lifecycle, from data collection for model training to retention, deletion, and secondary uses. Privacy by design means you design data flows, model pipelines, and access controls so that privacy norms are enforced by architecture, not bolted on later. Privacy-enhancing technologies, such as federated learning, differential privacy, and encryption, can help reduce or avoid centralizing raw personal data for AI training. Banks should treat model training and operational decision-making as separate purposes under DPDP, with transparent notices and specific consent where needed. The sixth risk is that AI systems themselves become attack surfaces and weapons through adversarial inputs, data poisoning, or compromised agents. The governor referenced incidents where AI agents, left to test security systems, eventually learned to break into them, illustrating that these AIs themselves can attack you. In banking, we must consider deepfake-based social engineering, AI-generated phishing, tampered training data for fraud systems, and prompt injection attacks against AI agents with system access. RBI and other sources emphasize red teaming. Systematically attack your own AI systems with adversarial prompts, poison data, and edge cases before and after deployment. AI can also strengthen defense by powering SIM systems, anomaly detection, and behavioral analytics to detect unusual patterns quickly. Governance must include kill switches to disable compromised models, clear incident reporting for AI-related cyber events, and documented playbooks for containment and recovery. RBI's Free AI Committee proposed a structured framework to both enable innovation and mitigate AI risks in financial services. The 7 sutras include trust as the foundation, people-first approaches, fairness and equity, accountability, explainability, and safety and resilience. The approach is principles-based and proportionate, heavier requirements for high-risk AI applications and more flexibility for low-risk use cases, but always anchored in accountability and customer trust. RBI's draft model risk guidance makes clear that AI/ML models fall squarely within model risk management, not a separate universe. Banks are expected to have a board-approved framework, classify models by risk, maintain an inventory, and document ownership, performance, limitations, and validation history. The 3 lines of defense apply: business/model owners, independent risk/validation, and internal audit, with higher scrutiny for models that affect customers materially or pose systemic risk. Phase 1 is about visibility. Know where AI is used, what data it touches, and which risks it introduces. Most banks underestimate the number of hidden models in use. Phase 2 focuses on establishing governance, policies, committees, explainability tooling, validation routines, and red team exercises, aligned with RBI guidance and DPDP. Phase 3 is about making AI sustainable, continuous monitoring for drift, bias, and attacks, institution-specific playbooks, and stronger indigenous capabilities to reduce risky dependencies. Remember that DPDP compliance is necessary but not sufficient for safe AI deployment in banks. It mainly addresses data rights, not full model risk. The 6 risks we covered give you a practical checklist for your own environment. Where do we stand on explainability, bias, concentration, vendor risk, privacy, and cyber threats? Governor Malhotra has emphasized that the winners in the AI era will be those with the strongest accountability and customer trust, not just the most aggressive adopters of AI. Use these questions to anchor the content in your real environments. Group discussions or casework will surface practical gaps. Think across silos: legal, compliance, risk, business, IT. AI risk management is not a single function responsibility. If you are interested in trying out the DPDP Act provisions, you can use the Consent Manager Simulation portal at myconsentmanager.co.in to test your integrations as a data fiduciary or data principal. We recommend the Calpi Quiz app, available on the Google Play Store, to test your knowledge of cybersecurity, the DPDP Act, and other important topics. The app offers various levels of difficulty and interactive assessments to improve your awareness. Thank you for watching this video relating to solutions to be considered for RBI's AI risks. Hope you now know more about AI risks identified by RBI in relation to AI. This was the 48th video in this series, released by DPDPA-mentor.in. Please visit our YouTube channel, DPDPA Mentor, as well as our website, DPDPA-mentor.in, regularly to check out other informative resources. Wishing you a successful DPDP Act implementation.